Can you pay the bills? Keep paying my telephone bills. Keep paying my bills.
This video is on liquidity. Liquidity is the ability of a company, or any organization really, it could also include a scrub or a balla like me, the ability to pay short-term bills as they become due. Let's get started with taking some notes. Liquidity is the ability to pay bills as they become due, or more specifically, the ability to convert assets to cash in order to pay current obligations. So if a company has a short-term investment or investment in a stock fund, that's much easier to convert into cash than, let's say, buildings and equipment. So we would say that that stock fund is a much more liquid asset than that building or equipment. A company's liquidity is closely related to its operating cycle. An operating cycle is the company's period, it's a period of time, and it relates to the period of time in which the company runs its operations. And let's specify what those operations are. Period of time needed to, for typical merchandising manufacturing companies, make or buy goods from the supplier. Sell those goods to customers. Collect the cash related to those sales to customers that presumably were on account. And then take some of that cash and repay those suppliers that we purchased the goods from when we started the operating cycle. And if you think about this from a journal entry perspective, when we're making goods or buying raw materials and putting them into production, what we're going to do is have our inventory increase. Could be our raw materials inventory is then go into production. Could be we're buying finished goods inventory, holding it, and accounts payable will increase. So we see our current assets go up and our current liabilities increase. We sell the goods to customers. When we have our sale, we are going to record revenue, increase in revenue, and an increase in accounts receivable, assuming the sale was on credit. Otherwise, we would have an increase in cash. And we would have a decrease in inventory because we're giving the inventory to the customer, and a corresponding increase in the expense cost of goods sold. When we collect the cash from the customer, from a journal entry perspective, cash is going to increase, and that account receivable will then decrease. And we pay our suppliers, our cash will decrease, and that initial account payable that we recorded early on in the operating cycle is going to decrease. And so what we see here, the operating cycle is affecting our gross profit section of the income statement, sales revenue minus cost of goods sold. Every time we complete the operating cycle, we earn our gross profit. So the shorter the operating cycle, the more frequently we're going to collect our gross profit. That's going to be a good thing. And then we also see current assets here, inventory, accounts receivable, and cash. We also see current liabilities, accounts payable here. So when we talk about liquidity, we think of the operating cycle, and we think of the operating cycle, we think of the current assets and current liabilities section of the balance sheet. Quick definition before we put together about the current assets and current liabilities section of the balance sheet. The current asset classification, typically we say current assets are those that are going to be used, sold, converted into cash within 12 months of the balance sheet date. And the technical definition is those assets that are expected to be spent, like cash, sold, like short-term investment securities or inventory. Collected, like accounts receivable, or used in operations like supplies, prepaid rent, prepaid insurance. In the longer of 12 months of past the balance sheet date, that's what we normally say, within 1 year of the balance sheet date, or the company's operating cycle, whichever is longer. Typically, a company's operating cycle is going to be significantly shorter than 12 months. We want it to be as quickly as possible to capture that gross profit. So oftentimes it is going to be that 12-month period, or 1 year from the balance sheet date. And so let's look at the balance sheet. The balance sheet is at one point in time. It's also known as the statement of financial position. We have our assets, which are the resources that the company is going to use to run the business, to hopefully generate revenues and generate income. And on the other side of the assets, we have how those assets are financed, with liabilities, amounts that are owed, and stockholders' equity, the owner's claim to the company. Right now, we're just going to focus on the current section. So we're going to have our current assets and our current liabilities. We're going to list our current assets in the order of liquidity. So of course, the most liquid of all our assets is cash. And then typically it's going to be short-term investments. This is the company when the company has excess cash and it doesn't see any other investment opportunities related to its business, what it might want to do in order to earn a return is to purchase debt and equity investments in other companies, other organizations. Sometimes we see the term, instead of short-term investments, sometimes we see the term marketable securities. And if they plan to be sold within 1 year of the balance sheet date, then they're going to be classified as current. Accounts receivable are also liquid. They're expected to be collected in cash within usually it's 30, 60, or 90 days of the date of sale, so well within that 1 year of the balance sheet date. Important to know about accounts receivable, it's the company is selling on credit. There's no contract. It's not formal. The company does business with its customer regularly, and no interest is charged. It's free credit to the customer. Notes receivable differ from accounts receivable because notes receivable are formal contracts. When a company issues a note receivable, it's a lender, just like a bank, but it doesn't necessarily need to be a financial institution. But that's what it's doing. It's lending to another party. Typically, it's going to be a customer. There's a formal contract that the customer must sign, and the company that's issuing the note receivable will generally charge interest to the customer. We have inventory, cost of the product that the company is making, and prepaid assets, also known as prepaid expenses. A company pays cash in advance of its rent, its insurance, its taxes. We call that prepaid assets or prepaid expenses. Please don't be fooled if you see the term prepaid expenses. It looks like something that would go in the income statement as a cost incurred during the period, but it's actually an asset. And then we're always going to see in the balance sheet a subtotal for total current assets. Now, obviously, you can't pay a bill with prepaid assets. You can't pay a bill with inventory, although you can sell that inventory for cash and then pay it off. So not all of our assets, such as prepaid assets, are going to be able to be used to pay our current liabilities. Current liabilities, usually, they're going to go in order of what does the company expect to pay most quickly after the end of the balance sheet date. Typically, we're going to see accounts payable listed as the first current liability. Like an account receivable, an account payable is not a formal contract. No interest cost is incurred by the company who has the account payable on its books. The company is typically borrowing from its suppliers who it normally does business with regularly, and in exchange it has this payable, and payable terms, usually payment is expected by the supplier in about 30, 60, or 90 days from the date that the purchase is done. Accrued liabilities or accrued expenses. So we might say accrued expenses or accrued liabilities. So are also short-term liabilities with no interest accrued. And these are just miscellaneous costs that the company still owes or has outstanding. Some examples might relate to wages or compensation, salaries, bonuses to employees, taxes owed to the government, sales taxes, income taxes, interest. So oftentimes all of these payables are lumped together and reported in the account accrued expenses. When the company does have a formal loan, we call that a notes payable. It'll be in the current section if that note must be paid within 12 months of the balance sheet date, or the operating cycle, whichever is longer. The company might have a long-term debt, and the year that long-term debt or year before that long-term debt is due, the company is going to separately report the current portion of the long-term debt. We're trying to show the investors this is the stuff that we're going to need to pay within 1 year of the balance sheet date. And then one other current liability we'll often see is unearned revenue. And I want to note that this is the only liability that is not paid in cash. Remember, unearned liability, it looks like it'd be a revenue account on the income statement, but it represents customers paid the company cash in advance of goods or services, and now the company owes goods or services to those customers in the future. And this is going to give us our total current liabilities.